The trading world is filled with a vast ocean of patterns. The bullish engulfing, the bearish engulfing, the hammer, the shooting star, the evening star, the harmonic, and the flag. Every one of these unique formations exists for a reason. While some of them might seem confusing or obscure to you right now, providing clarity is exactly why I created this video. I am going to review every single one of these patterns to the absolute letter, explaining their purpose and the underlying mechanics of why they form. By the end of this video, every line, color, and shape on your screen will make perfect sense. These patterns are far more than just random aesthetic designs on a chart. They represent actual tangible market movements that occur repeatedly because of the collective behavior of other traders. Once you understand them, you can truly capitalize on them. I won't just show you how to spot them. I'm going to teach you exactly how they function, so you can use them to your advantage every single time you trade. Before we dive into the deep end, however, there's one very important thing to understand. Out of all the patterns I am about to teach you, you do not need to use every single one of them in your daily routine. I am educating you on the full spectrum so you have a comprehensive knowledge base. But to be a successful trader, you really only need to master between 5 and 10 of them. As we go along, I will specifically point out the ones I rely on every single day to maintain my success, and distinguish them from the ones you might not necessarily need to use. I will still explain those secondary patterns and how they are utilized so you can have total peace of mind. This way, when you see them on a chart, you can identify them instantly rather than feeling lost, even if you know they aren't essential for your personal profitability. With that groundwork laid, let's begin. The anatomy of the candlestick. First and foremost, we must define what a candlestick pattern actually is. To grasp this, you have to realize that price charts are built from different types of visual data. You might see a simple line chart or a bar chart, but the most widely recognized and utilized version is the candlestick chart. Those red and blue, or black and white, boxes you see, which you can customize to any color you like, are the candlesticks. They are called candlesticks for a very literal reason. The little lines at the top and bottom of the central box resemble the wicks of a candle where you would place a flame. When this visual concept is applied to financial charts, it creates the landscape we see every day. You should keep in mind that the size of the candle is a direct reflection of market volatility. A larger candlestick indicates a bigger move, while a smaller one represents a minor fluctuation. Every single piece of data provided by a candle is an advantage for you. If a candlestick ends with a large body, it carries a specific meaning. If it has a tiny body, that signifies something entirely different. Even a candle with no body at all, just a line and a small cross-section, provides highly effective information. In essence, when you are reading candlesticks, every box and every line is telling a story, indicating whether the market is moving in favor of your trade or against it. You must ensure you are interpreting these signals correctly, and remember that while they appear on all time frames with the same look, their impact and weight can vary. Momentum, the long day and the short day. Let's look at our first fundamental example, the long day. This is exactly what it sounds like, a candlestick with an unusually long body. This elongated body identifies a market with a massive amount of momentum. It shows that for that specific period, the directional force was incredibly strong, suggesting that the momentum is likely to carry over into the next period. This serves as a vital indicator. If you are already in a trade, it tells you to keep holding. If you are looking to enter, it tells you to move with that force. While colors vary, we typically use green for buyers and red for sellers. A big green long day means buyers are dominating, while a big red one means sellers are in total control. In direct contrast to the long day is the short day. Again, the name is self-explanatory. When there isn't a significant body or large wicks, we call it a short day. This is the visual representation of a choppy or slow market, often referred to as consolidation. It means the market simply didn't move very far, which is an inevitable part of trading. Some days are fast, others are slow. Learning to identify a short day allows you to recognize market indecision. It signals that the market is currently unsure if it wants to continue its current trend or reverse, and it is likely gathering energy for its next major move. Rejection and reversals, belt holds and stars. Next we have the belt hold line. This is a simple long candlestick, green for bullish and red for bearish, that opens at its absolute high or low and closes near the opposite end of its range. It signifies a potential reversal, especially when it appears after a long trend. This is also known as a market rejection, often accompanied by a large wick. Think of it this way. On a real candle, the wick stays behind as the wax melts. In the market, the price may have traveled far, but it melted back, leaving a trail, the wick, that shows where the price was rejected. Moving on to morning stars and evening stars. The names are very intuitive. A morning star represents the start of a new day, meaning things are looking up. It is a 3-candle formation. 1 red candle, 1 small indecision candle, and 1 large bullish engulfing candle. This shows a complete reversal from a downward move to an upward one. This is personally one of my favorite patterns that I use every single day when I am looking to buy. The evening star formation is the exact opposite. It's like the sun going down on a trend. This reversal pattern indicates the market is headed for a move to the downside. Like its counterpart, it consists of 3 candles, a green candle, a small rejection candle, and then a bearish engulfing candle that forces the market lower. This is one of my favorite entry signals. Along with my core strategy, these 2 star patterns are some of the most powerful entry signals you could ask for. They are highly effective, especially when considered across various time frames. I highly recommend writing these down and starring them in your notes. The power of rejection, shooting stars, and crows. Next is the shooting star. While it might not look exactly like a celestial object, if you use a little imagination, you can see it. This candle appears at the potential end of an uptrend and consists of a very small body with a long upper wick. This tells us the market has no power to continue climbing and is rejecting higher prices. It indicates that buyers have stopped pushing and sellers are now stronger. This is another of my top-tier favorite entry signals because it provides clear confirmation that a reversal is imminent. We also have the 2 crows pattern. This is a bearish reversal pattern that occurs within an uptrend. It involves a long green candle followed by a similar red candle that opens within the body of the previous one but closes much lower. This pattern signals a distinct shift in momentum from the buyers to the sellers. Inside and outside patterns. Next, we have the 3 inside up and down patterns, which are very simple yet highly effective. 3 inside up is a bullish reversal that starts with a large red candle, followed by a small green candle contained within the previous body, and a third candle that closes above the first candle's high. Conversely, 3 inside down is the bearish version. It starts with a large green candle, follows with a small red inside candle, and ends with a third candle closing below the first candle's low. The 3 outside up and down patterns are essentially the inverse. 3 outside up is a bullish pattern that begins with a bullish engulfing pair, followed by a third candle that closes even higher. 3 outside down is a bearish reversal that starts with a bearish engulfing pair and is confirmed by a third candle closing lower. Following these, we have 3 stars in the south, a bullish reversal consisting of 3 small-bodied red candles, each closing lower than the last. This suggests the bearish trend is gradually losing its strength. Then there are the 3 advancing white soldiers, 3 consecutive long green candles, each opening within the previous candle's body and closing higher. This is a very strong signal that a bullish trend is going to continue aggressively. The king of patterns, head and shoulders. Now we are moving into reversal patterns, and the next one I'm going to explain is by far my favorite and most effective. If I were to rank the top 3 patterns in my strategy, this would be number 1. I use this every single day and it is extremely effective. The famous head and shoulders and its counterpart, the inverted head and shoulders. A head and shoulders pattern forms at the peak of a trend. It isn't officially confirmed until it breaks and retests the neckline. It consists of 3 peaks, the left shoulder, the first rejection, the head, the highest peak created by a final burst of momentum, and the right shoulder, a third peak that fails to break above the head. Once the price breaks below the neckline connecting these points, the reversal is confirmed. This is one of the most successful patterns I use, and I often try to only take trades that present this clear visual structure. The inverted head and shoulders is simply the same concept flipped upside down at the bottom of a downtrend. It consists of 3 troughs, the left shoulder, a deeper trough for the head, and a final right shoulder that fails to go lower than the head. When the price breaks and retests the neckline to the upside, it confirms that the market is no longer bearish and has turned bullish. These patterns happen more often than you might expect. My biggest tip is, the cleaner the visual, the better. Don't try to force a head and shoulders if it isn't clearly there. Double and triple tops / bottoms. My second favorite reversal pattern is the double top and double bottom. While highly effective, I'd rate it a 5 or 6 out of 10 in effectiveness compared to the Head & Shoulders 8 out of 10. However, they are much easier to spot. A double top occurs when the market hits a resistance point, rejects, returns to that same point, and rejects again. It looks like two equal peaks or cones. The ideal entry is the retest of the neckline. These happen more frequently than Head & Shoulders because they are less complex, but that frequency also means you need to be a bit more careful with them. The double bottom is the same thing, just reversed at the bottom of a trend to signal an upward reversal. Then we have the triple top and triple bottom. As you might guess, it's a double top or bottom with an extra rejection point. This is even better because it provides an additional layer of confirmation that the price is struggling to break a level. Be selective though. If the middle peak is higher than the other two, you're actually looking at a Head & Shoulders. A triple bottom at the low of a move is a very strong signal, and the most effective trade is taken at the retest of the neckline. These three patterns, Head & Shoulders, double tops, stauncher bottoms, and triple tops bottoms, are the ones I recommend focusing on. It took me 4 years to master them, but the sooner you do, the better your results will be. The hammer and hanging man. Next we have the hammer and the inverted hammer. The hammer is a bullish reversal candle at the bottom of a downtrend, featuring a small body and a long lower wick. It looks like a tool you could use to hit something. The inverted hammer is also a bullish reversal at the bottom of a trend, but with a long upper wick instead. We also have the hanging man and the shooting star. The hanging man is a bearish reversal pattern that appears at the top of an uptrend. It looks exactly like a hammer, but because of where it appears, at the top, its meaning is different. The shooting star, as mentioned before, is the bearish rejection at the peak of an uptrend with a long upper wick. Engulfing candles. The ultimate confirmation. Now we come to what I consider my top 2 or 3 entry signals, the bullish and bearish engulfing candlesticks. If morning stars are my number 1, engulfing candles are my number 2. The concept is simple. To engulf means to swallow up or be bigger than the previous thing. A bullish engulfing candle is a green candle that is larger than at least the last 2 red candles combined. This can happen at support or as a continuation signal. A bearish engulfing candle is a red candle that eats the previous 2 green candles. These are very similar to morning and evening stars. It doesn't matter much which one you call it. Both make your trade better and your confidence higher. I personally will not take a trade unless I see one of these engulfing formations or a star formation. They are the cornerstone of my set and forget strategy. Harami. Piercing lines and tweezers. Next is the Harami candlestick. A bullish harami is a small green candle completely contained within the body of a large previous red candle, suggesting a reversal. The bearish harami is a small red candle inside a large green one. Then we have the piercing line and dark cloud cover. A piercing line is a bullish reversal where a long green candle opens lower but closes above the midpoint of the previous red candle's body. The dark cloud cover is the bearish opposite, where a red candle opens higher but closes below the midpoint of the previous green candle. Finally, in this category, we have tweezer tops and bottoms. I use these occasionally. A tweezer top consists of 2 or more candles with nearly identical highs, suggesting an uptrend is ending. A tweezer bottom has identical lows, suggesting a downtrend is finishing. Continuation patterns. Flags and pennants. Now we move into continuation patterns. Many of these involve trend lines. I should be honest. I am generally against trend lines because I find them too subjective. If everyone sees a line differently, it's hard to call it a reliable system. I prefer systems that are objective, where everyone sees the same thing. However, I want you to be aware of these. The bullish flag forms during a strong uptrend and looks like a small downward sloping rectangle, the flag, on a steep rise, the pole. You expect a breakout to continue the trend. The bearish flag is the inverse, occurring during a sharp decline. Then we have pennants, which look like small symmetrical triangles. A bullish pennant suggests a strong move up will continue, while a bearish pennant suggests the downward momentum will persist. Rectangles and triangles. Rectangles are actually my favorite continuation pattern, often called consolidation breakouts. A bullish rectangle is formed by 2 parallel horizontal lines acting as support and resistance. It's essentially a break and retest strategy once the price moves out of the box. Bearish rectangles work the same way, but break to the downside. I love these because they are objective. It's just a box. It's much clearer than a triangle. Speaking of triangles, we have the ascending triangle, flat top, rising bottom, which usually breaks upward, and the descending triangle, flat bottom, declining top, which usually breaks downward. A symmetrical triangle has both lines converging and can break in either direction, usually following the prevailing trend. Wedges and necklines. The famous rising and falling wedges are next. I used these early in my career but didn't find much success with them. A rising wedge is a bearish pattern where the lines converge while moving upward, suggesting weakening momentum. A falling wedge is a bullish pattern where lines converge while moving downward, suggesting a bearish trend is losing steam. We also have the on-neck, in-neck, and thrusting lines. These are all bearish two-candle continuation patterns in a downtrend. The on-neck closes near the previous low, the in-neck closes slightly inside the previous body, and the thrusting line closes more than halfway into the previous body. All three suggest that the sellers are still in control and the trend will likely continue downward. Indecision. The dojis. Next, we have the neutral or undecisive candles known as dojis. We touched on these earlier, and they are extremely effective when combined with other patterns like engulfing or star formations. However, on their own, they represent a lack of momentum. A standard doji has a tiny or non-existent body, showing a perfect balance between buyers and sellers. When you see these on high time frames, be careful. Indecisive markets can slow down your trade or keep you out of one because there isn't enough movement. I've seen these patterns last for weeks, where the market just moves up and down slightly but goes nowhere. This is a signal to step back and wait for momentum to return. The long-legged doji is the same but with much longer wicks, suggesting an even greater struggle. These can be dangerous because they often precede a violent breakout. Think of a surfer. You don't go out when there are no waves. If you enter a market with no volume, you're just waiting for a shark, a stop-loss hit, to find you. Stay away from these unless you're using them specifically for a reversal confirmation. Finally, we have the dragonfly doji, looks like a T, signaling a bullish reversal, and the gravestone doji, the inverse, signaling a bearish reversal. There's also the spinning top, which is very similar to a standard doji and represents the same indecision. Don't let people sell you different strategies based on these. At the end of the day, they all mean the same thing. The market doesn't know what it's doing yet. You need a strategy behind these candles. You cannot trade them alone. The powerhouse, the Marubozu. We will conclude with one of my favorite continuation candles, the Marubozu. This is a very powerful candle that you rarely see on higher time frames because it represents extreme strength. A Marubozu consists of one big block with no wicks at all. This means from the second the market opened, it moved in one direction and stayed there until it closed. There was no fluctuation and no pullback from the opposing side. Whether it is a bullish Marubozu or a bearish Marubozu, it is a key indicator to hold your trade or get into one quickly, because the momentum is undeniably strong.